So during his trip to Europe, Xi Jinping visited France, Serbia, and Hungary. The main agenda was to remind Europe that China could indeed provide big economic benefits. While the EU still pursues decoupling from the East, their economies are still burning. Being cut away from cheap Russian gas was their biggest mistake. It has been nearly 2 years, but the effects are still being felt, especially in Europe's biggest economy. In the latest report, German factory orders have dropped once again. March demand has fallen by 0.4% when analysts were predicting a gain of 0.4%. This is a big 180 turn from growth to contraction. Since the war started, German products are becoming more expensive, especially when it comes to cars. Factory orders were consistently below 100 for 24 months. This is a clear sign that their manufacturing is contracting. Many German companies are suffering, their bottom lines are getting hammered, and we are getting warnings from many automakers. Daimler is warning of a difficult environment. Mercedes is waving the white flag, and it gets even worse for Volkswagen. Their operating profit has dropped by 20% in Q1. The reason? A decline in sales and higher input costs. The company wants to introduce new models, but they can't do it without jacking up the cost. They simply can't manufacture at a competitive price today. The last thing German companies want is to decouple with China. It's kind of funny how different the thinking is between politicians and people in business. Volkswagen and other car bosses are warning against punishing Chinese EVs. So if Scholz goes ahead with tariffs, China could indeed retaliate back on German car brands. And considering over 30% of their car exports are sold in China, this could devastate their companies. While Western Europe is still struggling with this Chinese issue, Eastern Europe is getting a great deal from President Xi. China just checkmated the EU. Economic winter is coming for the West, while Hungary and Serbia, they're about to usher in a golden age of trade. During his trip to Serbia, Beijing announced the implementation of a free trade agreement. This is big news because it almost guarantees Serbia's prosperity when trading with China. Economic barriers have been torn down. And here's how impactful this FTA is between China and Serbia. The Serbian president says the deal will guarantee a future for Serbia. 95% of all Serbian exports to China will have zero tariffs. There will be no additional taxes on goods sold from Belgrade to Beijing. Exports from Serbia will start to fly higher, and this will help to build the Serbian economy just from trade alone. And we are not even factoring in billions in investments coming down the line. Meanwhile, in Western Europe, there's a tariff war going on with China. EVs made in Europe face a 15% tariff selling to China. Chinese EVs are subjected to a 10% tariff selling into the Eurozone. We are beginning to see Europe itself shift into two blocks. The eastern half, including Hungary and Serbia, they are moving closer towards China. They are reaping the economic benefits, while Western Europe, which is aligned with the US, is enjoying higher energy prices, higher export tariffs, and collapsing exports. By giving a ton of investment plus enabling free trade, Beijing essentially sidelined the rest of Europe. Where Xi Jinping upgraded China's ties with Hungary to an all-weather partnership, they essentially snubbed Brussels. China is making Hungary the leading country in the EU, especially when it comes to Chinese relations. In the years ahead, especially in EV, we can expect Hungary to compete and maybe even challenge heavyweights like Germany. And this will be powered by Chinese money and technology. It's very important we understand why Hungary and Serbia they are aligning with Beijing. They see China's economy as the future. China's economic growth will dwarf the world. According to the IMF, China's economy will account for 21% of global economic growth for the next 5 years. Beijing is going to be the new economic center of trade. Partnering now will help Hungary and Serbia ride the wave up. Conversely, the G7 will only account for 20%, and this includes the US as well. China's visit to Europe isn't really to beg France or Germany to buy more EVs. It's more of a victory tour to reward countries they are working with. For many months now, we have heard the story, the narrative of China's collapse is coming tomorrow, it's coming next week, maybe it's going to come the next hour, that the world is isolating Beijing and countries want to decouple away at all costs. But the numbers we are getting just destroys that narrative. The world is still actively trading with China. The Chinese economy is rebounding fast and hitting their 5% GDP target is becoming very likely. China's trade has reversed from its slump in March, exports have increased by 1.5%, while exports have climbed by 8.4%, almost double digits. The world is still buying more Chinese products, and China is importing more from the global economy as well. The jump in imports is really interesting here. China isn't just buying random stuff from the world. Chinese companies are importing more from the US, South Korea, and Taiwan, and their purchases are concentrated around one vital commodity. The jump in imports was driven by products including chips and PC parts. We are seeing China starting to gear up for their next industrial push. Whether Europe or the US wants to admit it or not, the EV war has already been won, and they are not the winners. The next battleground China is moving to conquer is in high-tech chips. And that's why Biden has moved to revoke Intel and Qualcomm licenses to sell chips to Huawei. They want to curb China's progress on the final frontier, which is AI chips. And this is only going to hurt the profits of US companies. Intel themselves admitted that this ban will hurt their revenues in Q2. This won't halt China's progress. It might slow things down for a year or two, but the sheer size of the Chinese industry will leapfrog the ban. Countries that can think objectively are starting to make the shift. Give it 5 or 10 years, this overcapacity hysteria is going to happen again. But it won't be over EVs, but over AI chips next. And once China closes the gap, they bridge the gap, the sheer size of their factories will drive the cost of chips down. At that point, it will be essentially game over. China will be the Amazon of everything in the world for virtually everything, from toys to clothes, all the way to high-tech AI chips. Now, while the Chinese economy is recovering, the US is facing a big problem. They are spending too much money. It's getting harder and harder for the world to keep funding Biden's government. In the latest Treasury auction, we are starting to see demand slip. US auction is being met with tepid demand. Buyers of US debt are realizing one horrible fact, that Joe Biden won't stop spending to prop up the economy. The 10-year yield has rebounded higher, nearing 4.5%. The 10-year yield is a very important benchmark. When it goes higher, all other borrowing costs also shift up. From your personal loans all the way to mortgage rates, everything will have to move up higher as well. Most recently, Warren Buffett sold his shares in Apple to buy treasury bonds. His company Berkshire will sit on around 200 billion worth of T-bills. But even Buffett's buying is nothing. It's nothing compared to Yellen's issuing of US debt. It's just a tiny amount of demand. There's simply too much supply circulating around. The current treasury is about to hit a $125 billion brick wall. That's how much new debt is going to flood the markets over the coming week. $58 billion in 3-year bonds and $67 billion of 10 and 30-year debt will be sold. And here's the big problem with this endless selling of US bonds. Sooner or later, the world will stop buying. There will come a point in time when people just wake up and realize that the US government can never pay back the debt. And a big thank you to our sponsor today, IPM Bullion. When it comes to buying precious metals, my number one dealer in Singapore is IPM. They have made investing in precious metals safe, fast, easy, and simple for both small and large scale buying. Now, as we all know, the price of gold has been rising higher and higher. Just 5 years back, it was around $1,200. It's over 2,000 today. Getting just an ounce of gold is getting harder and harder to afford. Now, I've been there many times when I'm saving up for an ounce and prices suddenly shoot up beyond my reach. Now I have to pay more. Thankfully, there's a solution to this. The IPM Gram Savings Plan is a great way to accumulate gold at your own pace without missing out. You can buy as little as 1 gram of gold and buy on your schedule. The grams are fully owned by you and they're held in secured and segregated vaults in Singapore. The gold is physically backed, it is insured, and you can sell it at any time back for cash. Best of all, when you accumulate 1,000 grams, you can exchange it for a full kilobar of physical gold. There's no extra cost in this conversion, and the kilobar is LBMA certified, and you can test it on the spot as well. So take action, click on the link below and get a discount for your first purchase with the code SeanFu. Start with IPM today. The world is watching how much America is borrowing, especially today when rates are sky high. The Congressional Budget Office has released its new estimates and it's looking really horrible now. They expect the 10-year yield to stay well above 4.2% until 2054. Why? Because the government keeps spending money to prop up the economy. As a result, this is also affecting the average rate on the federal debt. It's around 3% today. but it's going to keep rising higher and higher for the next 30 years. By 2054, the average rate of borrowing will be much closer to 4%. We are on this endless treadmill of deficit spending that is making the national deficit worse. Sooner or later, it will come to two simple choices. Does the US Treasury default on the debt or beg the Federal Reserve to print money to pay back all the creditors? Either way, this is a big problem for bondholders. It's either a global debt crisis or global devaluation disaster. Your buying power will take a brutal hit. This is a game of musical chairs. It's a risky game, and it seems that some countries, in fact many countries, are calling it quits. And this is perhaps the most important chart today. It shows us the foreign share of US Treasuries falling. In 2008, countries they really love US debt. Over 55% of holdings belong to foreigners. But over the next 15 years, everyone started divesting away. We had the bailouts in 2008, the stimulus in 2020, and of course the sanctions 2 years back. We are seeing global trust in US debt literally crash down. The importance here is the percentage. Now, the nominal amount of debt will always be increasing because the world as a whole is getting richer. They have more surplus to invest. But because there's so much debt being issued today and trust is eroding, countries they're simply moving away. They rather put their money elsewhere. And where are they putting it in? They are putting it in gold. Once again, this being led by central bank buying from China. At this point, it's not a surprise anymore. The PBOC added another 60,000 troy ounces of gold in April, and this marks the 18th straight month of addition to their central bank reserves. China's essentially announcing to the world that they are divesting away from the United States. They are moving away from dollar assets into gold. And there are many reasons why countries are making the shift. There's of course the sanctions on Russia and the issue of counterparty risk. But even if we take that away and we just play dumb, we assume Biden never sanctioned anyone, there's another big risk to consider. US monetary policy is another threat countries are waking up to. The whole purpose of buying US debt is to protect your reserves while earning interest. You want your money to be there when there's an economic crisis. However, this logic has broken down over the past 2 years. Take Japan's holdings of treasuries for example. Because of the rate hikes, the value of their US bonds have collapsed. Recall the relationship. When rates go up, bond values will plummet. Japan's holdings went from $1.3 trillion down to only $1.2 trillion within a matter of months, and that's an 8% loss. And because the Fed has to stay higher for longer, the losses are going to stay. And this comes at a time when Japan's currency is collapsing. They had to intervene by selling US dollars to buy back the yen. In the most recent intervention, Japan spent $23 billion in cash to rescue the yen. Where is this coming from? It's coming from their holdings of US treasuries. They had to book a horrible loss to raise the dollars necessary. Now, if the BOJ bought gold instead of treasuries, they wouldn't suffer a loss. They wouldn't be 10 or 15% down on their reserves. They would be at least 15% up. They could sell the gold at a profit to save the yen. And that's how reserves are supposed to work. It's another reason why countries they are moving away from dollar debt. US debt might feel safe, but if a crisis happens, the value of your reserves could drop fast. You won't have enough firepower to save your economy or, in Japan's case, your currency. At the very least, you have to book a loss to raise the cash. So don't expect the gold buying to stop. Things have fundamentally changed here, and they're about to get crazier. Crazy things are about to happen. Events that are horrible for the dollar but great for gold. It's important we realize the narratives are breaking. China is collapsing tomorrow, right? But is it really? The economy is still growing. If China is collapsing, why are the EU and the US afraid? Why are they punishing China? Another big narrative is that the US bonds is the gold standard of all investments. It's the ultimate safe haven asset. But if that's the case, why are countries moving away? Why don't they sell everything they own for treasury bonds? So we have to be smarter here, guys. There's a lot of noise going around, and it's all about pushing a certain agenda to the world. But let me know what you think. Will Europe finally embrace China one day? Will central banks further move away from treasury bonds? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.